Today we're going to talk about investing for your retirement. I know it's a long ways off for you. All you're thinking about is getting to May and getting to graduation. But as that compound interest article we read the other day showed us that the earlier you start investing for your retirement, the more you're going to have when you actually retire. So again, I know at 18 years old you really don't want to think about that, but it's definitely something to start thinking about. And so I want to give you some things that you'll probably hear about as you get into the workforce, and maybe next year, maybe it's 5 years after college, or 5 years now when you graduate college. But some things that I want you to consider looking at for your retirement. Okay. So pensions and retirement accounts. So these are going to be ways that you're going to retire. That way you can have an income after you are done working. So the first one is an IRA. So an IRA stands for an individual retirement account. Pretty simple, IRA. Okay, and this you can just go get set up with a financial advisor of some sort. You find one in the on the internet, and you trust them. They have good reviews. You go find them, and you can start setting up an IRA with them, individual retirement account. With an IRA, it is $6,000 is what you can pay into it. It should be 2020 as well. So $6,000 is what you can put into an IRA each year. Now, with that, with a regular IRA, that money is taxed when you pull your money out. Okay, so as you put your money in, it's tax-free, but as you pull your money out, then you're going to get taxed. So imagine if you are, 65 years old and you go to pull out this IRA that has maybe $500,000, maybe $1 million in it, whatever, how much ever you saved in there, and you go to pull a big chunk of that out, then you're going to be taxed on it. So that's a downfall of an IRA. A Roth IRA, again, it's a Roth individual retirement account. This is a little bit different in the sense of when it's taxed. So again, a Roth IRA, you can put up to $6,000 in the Roth each year. Okay. This one, though, the advantage here is this is taxed when you put it in, and it's tax-free when you pull the money out. So let's say I go ahead and put, $6,000 in this year. I take, $500 every month on my check, and I put it into this Roth IRA. It's taxed as it goes in. Therefore, when I go to pull it out, let's say when I retire, I want to pull out $100,000 or something. It's all tax-free. That's all my money. None of that money then is going to the government. It's all tax-free. So that's an advantage to a Roth IRA over just an IRA. A 401k and a 403b. You've probably heard of a 401k before. So this is basically a pension or retirement account that is in the private world or the private sector. This is basically where your employer is going to put so much money in. They're going to basically match what you put in up to a certain point. And then that money will be invested basically in an account in the stock market. And so you have this, rolling over every year, 13%, hopefully on average increase. But again, so if you put $200 in your 401k, then your employer would put $200 in your 401k. A 403b is very similar. It is just on the public sector. So a teacher would get a 403b. A city worker would get a 403b. But again, these are retirement accounts as well. And this you can put up to $19,000 each year into one of these accounts. IPERS is a great retirement account here in Iowa. It stands for Iowa Public Employee Retirement System. Again, I'll say that again. Iowa Public Employee Retirement System. So what this does is basically that it's for Iowa public employees, teachers, city workers, county workers, government employees, that we can go and take our IPERS. So what IPERS does is basically I, as an employee, put in 6% approximately, and my employer puts in 1.5 times more of that. They put in 9%. Okay, so think about it this way. If I put in $300 into my account or into my IPERS, I have it withdrawn from my checking or my check and put it in my IPERS at $300. My employer, West Liberty Schools, would then put in $450 into that account on the same month. So therefore, I'm getting $750 from both of us, $300 from me, $450 from my employer, and that's going into my IPERS. So it's a really, really good benefit for public employees here in the state of Iowa. Most states have something very similar. Ours is called IPERS. You may have heard about it before, or maybe you haven't. But it's another great advantage for Iowa public employees to have in that IPERS. A Kehoe plan. So a Kehoe plan is for individual businesses. And in this, you can save 25% up to $53,000. So let me clarify that once again for you here real quick. But a Kehoe plan, this is for basically a self-business, self-employed plan. Okay. So again, you have 25% up to $53,000. That amount is tax deductible. Therefore, you can take that out of your taxes. But again, a Kehoe plan is going to be one for a self-employed business. And the last thing I want to talk about as far as investing for retirement is real estate. As we talked about at the very beginning about wealth accumulation, and you can begin to accumulate wealth. Maybe in the long run, you can start to, maybe invest in some real estate where you're going to, buy a house and turn it into an apartment. Okay, this is another great way of basically giving yourself some more wealth. The downfall in real estate is you're not going to get a return on your money real fast. You might flip your money and it might take a while. Maybe you sell it later. Okay, so a downfall there is you might not get your money back as fast as you might want it. So these are some ways to invest for your retirement. Different pensions and retirement accounts you might hear in the future, especially 401k. Probably a Roth IRA, you'll probably hear about that, maybe even just an IRA. These are some investments that you should be thinking about. Maybe not now, even though you should, but maybe it's one that you want to think about when you first have your first job, a real job, to start investing in some of this. Again, if you start thinking about it, that compound interest article, $18 a month until you retire, and you can be a pretty rich person. Compared to if you start retiring at 35, now you have to start putting in $200 a month to have that same benefit. So $18, it's not that much every month. Maybe just don't go to Subway or don't go out to eat for a couple times, and you can have that money invested, and then leave it in there, let it ride, and you'll be good. Also think about maybe if you get money for graduation, what you might do with that. Go out and buy a laptop or a new stereo or something, or maybe you put it in an IRA or a Roth IRA and let it grow and let it ride.